BlackRock is the largest asset management in the world, and after receiving 13F filing from SEC, we know which 5 stocks BlackRock was buying aggressively in Q1 2025. In this video, I will share with you 5 largest buys of BlackRock in Q1 2025. I will share my opinion about every of these stocks, and I will let you know if I think investment in these companies can provide market-beating return for investors. I will present these companies in order from smallest buy to largest buy. And without further ado, what's going on, investors? Hopefully guys are doing well out there. Welcome back to another video. BlackRock is a giant global investment management company with assets under management north of $11.58 trillion. And starting from the smallest buy in Q1 2025, the first company is Visa. Visa is taking 1.07% of the portfolio for BlackRock, and they own 144 million shares, which is north of $50 billion in Visa stock. They spent $2.45 billion on the new purchases of Visa shares. Visa is the largest credit card processor in the world, and the market share of Visa is reaching 39%. After Visa, we have UnionPay with 34% and MasterCard with 24%. In terms of the market share by purchase volume, Visa is taking 61% of market share. In terms of the share of active cards, here Visa is also dominating with a 55% market share. Visa's revenue is very stable and predictable. In 2015, they generated $13.8 billion in annual revenue. Fast forward to today, in 2024, they generated $35.9 billion in revenue. Absolutely mind-blowing growth, and this growth is expected to continue with the next 3 years up to the right, and projections for almost $48 billion in a year of 2027. Visa has one of the best margins in stock market, gross margin reaching almost 98%, with net and free cash flow margin north of 50%. Visa is already a mature company. Even though revenue still grow double digit, Visa is returning cash to shareholders with the buyback yield reaching 2.72%, and dividend yield is stable at around 0.6%. Here you can see the buybacks are changing based on the price fluctuation, so every time Visa is reaching more than 3% buyback yield, I think at that stage Visa is undervalued in the market. This aggressive share buyback leads to decrease in shares outstanding. In 2015, Visa had 2.2 billion shares outstanding, and currently Visa has 1.8 billion shares outstanding. The decrease in the shares is boosting EPS, which makes Visa looks less expensive. Visa is not stopping, and they keep innovating. AI is transforming how we shop and pay. Visa is bringing the power of its network and decade-long expertise to bring trust and security to AI-driven commerce. Soon, people will have AI agents browse, select, purchase, and manage on their behalf. These agents will need to be trusted by payments, not only by users, but by banks and sellers as well. So currently we have a lot of agents like ChatGPT, Gemini, Perplexity, and so on and so forth. So later customers will use agents to buy the plane ticket, to buy coffee, to order delivery, and so on and so forth. And Visa wants to take the market share and become a leader in this market as well, which is very nice to see. In addition, Visa is partnering with Bridge to launch stablecoin linked cards, which company says will allow users to make everyday purchases in cryptocurrency tokens. In terms of the valuation, and if I would buy Visa at current prices, projecting revenue growth of around 10% and net income margin stable at 56%, projecting the price to earnings multiple of 25 in the year of 2029, keep dividend of 0.77 and buyback at 0.50. We get upside potential for Visa in 5 years of 45% or 8% CAGR every single year. This is approximately the returns S&P 500 can deliver, so I believe buying Visa today will not provide the market-beating returns for investors, and I would not buy Visa at these prices. Coming to the second purchase of BlackRock, and this is IVV, taking 0.85% of portfolio for BlackRock. They own 71.59 million shares with the value of around $40 billion. And in Q1 2025, they spent $2.55 billion. IWW is actually iShares Core S&P 500 ETF, which holds the 500 largest US-based companies with expense ratio of around 0.03. So expense ratio is relatively cheap But the question for investors, if they want average market returns of around 7 to 8%, or they want to try to outperform the market by picking individual stocks. From the statistics of 20-year annualized returns by asset class, we can see that average investors can deliver 2.1%. Meanwhile, S&P 500 from 1996 to 2015 delivered 8.2% returns for investors. So watching at these statistics, I believe that investing in S&P 500 makes sense for average person who has full-time job, who does not have time to do a research and pick individual stocks, listen for the earnings report, reading the earnings report, research the competitors, and dig deeper into the numbers, read financial statements, and so on and so forth. But for me personally, I'm spending a lot of time reading the reports, reading financial statements, listening for the earnings call. I just enjoy it. So for me, I would like to outperform the market and deliver more than 8.2% return per year. Coming to the third purchase of BlackRock, and this is cloud giant Microsoft with a 4.62% of the portfolio with 583 million shares and $218 billion. They spent 2.65 billion buying Microsoft in Q1 2025. Revenue of Microsoft is absolutely the picture of beauty. In 2025, they generated $93 billion. Fast forward to today, in the latest 12 months, they delivered $270 billion. Absolutely mind-blowing growth, and the projections will continue to grow. Microsoft has a tailwind from AI, which keep boosting the revenue growth. Their margins are very high, with gross margins north of 70%, net income margins of 35%, and free cash flow margin is around 30%. Currently, the free cash flow margin is damaged because Microsoft is investing aggressively building the capacity for AI. But once they finish the AI investments, the margin will come back to 30% or even going higher to 32 to 35%. Microsoft is a relatively expensive company. We can see this from the buyback yield. Their buyback in 2016-17 was north of 4% of the company every single year. Fast forward to today, they are buying back less than 1% of the company per year and paying 0.7% in dividends. Buybacks are leading to the decrease in shares outstanding, not as fast as Visa, but still from 2015, from 8 billion shares outstanding, they went to 7.4 billion shares outstanding. Also good for shareholders. In terms of the cloud, Microsoft is taking market share. Amazon is the largest cloud provider, and Microsoft in 2017 had less than 15% of market share. Fast forward to today, the market share of Microsoft reaching almost 25%. So Microsoft is doing very good job, and they have a value proposition. They are taking market share from Amazon. Amazing to see. Microsoft business is very diversified. They have Microsoft 365 commercial, they have gaming with Xbox, they have LinkedIn, they have Windows, which whole planet is using, they have search with the Bing, and now AI powered search. They have a lot of different diversified businesses with very high profitability and net profit north of 25 billion. Microsoft is invested in OpenAI, and OpenAI recently hit $10 billion in recurring revenue. OpenAI is looking to hit 125 billion in annual revenue by 2029. Absolutely mind-blowing growth. In terms of the valuation for Microsoft, if I believe buying Microsoft here providing market-beating returns, projecting the revenue growth of around 15%, net income margin of 36, and price to earnings of 30, with dividend of 0.72 and buybacks of 0.5, we get 38% return in 5 years or 7% CAGR over the next 5 years. I believe that Microsoft will provide market returns, and you cannot beat the market by investing in Microsoft at these prices. During the April tariff market crash, for my portfolio, I bought Microsoft at $380 per share. I believe Microsoft is not a buy today. I would say Microsoft currently is a hold for me. Coming to the fourth largest purchase of BlackRock in Q1 2025, Amazon with 2.82% of the portfolio, 700 million shares, 133 billions of Amazon owned by BlackRock. They spent $2.82 billion buying more Amazon stock in Q1. Amazon's revenue look very similar to Microsoft's revenue. In 2015, they generated $107 billion. Fast forward to today, they are generating north of $650 billion. This is 6x revenue in 10 years. Absolutely mind-blowing. And in the future, the revenue is projected to reach almost $1 trillion. So I believe that Amazon will be the first company delivering $1 trillion in annualized revenue. In terms of the profitability for Amazon, during the COVID, they built a lot of capacity. The free cash flow dropped from positive $26 billion to negative $17 billion in the year of 2021 and 22. But currently it's rebounding, and in the latest 12 months, Amazon is printing in average around $30 billion in annualized free cash flow. And projecting for the next 3 years, in 2027, Amazon is projected to reach almost $100 billion in free cash flow. If I'm not mistaken, this will be the biggest amount of free cash flow among any public US companies in the world. In terms of the recent developments for Amazon, they built the generative AI video tool for advertisers. This tool will improve the conversion rates and improve the return on investment for advertisers in Amazon.com. Amazon is also testing AI-powered humanoid robots for deliveries. This is one of my core theses investing in Amazon 4 years ago. For me, Amazon is the largest bet on robotics in the future. I believe that robotics will help Amazon to improve retail margins significantly. And while Wall Street is focusing on AWS, growth of AWS, margins of AWS, I believe that through the robotics, cost cutting, and performance optimization, Amazon will improve operating cash flow margins to around 22%, which will significantly improve the profitability for this giant. In terms of the if I believe Amazon is a good buy today, projecting the revenue of around 9%, with operating cash flow margin expanding from 18% to 22%, with price to operating cash flow of 22, which is a historical average for Amazon. Without dividends and without buybacks, I still see potential for Amazon of 94% returns over the next 5 years, or almost 15% CAGR over the next 5 years. I believe that you almost can double your money in Amazon over the next 5 years, but to make sure you double your money, you need to buy Amazon at around $207 per share, and my projected price for Amazon in 2029 is $415 per share. Coming to the largest purchase of BlackRock in Q1 2025, Apple, with 5.35% of the portfolio. They purchased $3.73 billion of Apple stock. Apple's revenue is growing. They increased the revenue from 233 billion in 2015 to fast forward to today. In the latest 12 months, they printed $400 billion. But in terms of the recent developments from 2022, they already was north of 400 billion. So after 3 or 4 years, the revenue is actually not growing. And if we can see for 2025, analyst estimates is still almost no growth. Only from 2026 we see some kind of acceleration for the revenue growth. Apple is very friendly to shareholders. The buybacks are significant, 3.53% every single year. They are just buying back from the market, meanwhile paying dividends of 0.52%. The aggressive buybacks lead to significant decrease in shares outstanding. In 2015, they have 22.3 billion shares outstanding. Fast forward to today, they have less than 15 billion shares. This is very rapid buyback from the company. Recently, Apple had an event, WWDC 2025. Apple delivered updates in terms of the design, OS naming, AI innovations, Siri, wallet, and platform enhancements. From my perspective, what I like the most is live translation and on-device LLM access for developers. This is very nice. For example, for foreigners, if you live in foreign country, you can speak your native language, and on the fly this thing will translate to the language of the person you are talking to. I think this is very nice for the expats living abroad. Do I believe that Apple can provide market-beating returns for investors, projecting the revenue with 7% growth over the next 5 years, net income margin stable at 25%, price to earnings multiple of 25. With the dividends and buybacks, I see the potential for Apple stock to grow 40% over the next 5 years, or 7% CAGR every single year. I do not believe that you can outperform the market with Apple. I would say Apple is a relatively stable company, but on the other hand, 25 multiple for the company who does not really have a growth as for now. So we are giving a credit to Apple, projecting 7% growth. Currently, Apple is actually not growing. So in this case, I do not see a lot of margin of safety. I am Apple fanboy. I have a lot of Apple products, but I don't really believe that Apple can provide market-beating return for investors. There you have it. If you found this video helpful, consider subscribing to the channel. Thank you so much, my friend, for watching until the very end of the video. That's all for now. I will see you in the next one.